Today on InvestTalk, we talked about Warren Buffett's growing cash positions, answered questions on tickers ING, DEO, and what factors you should consider while investing, and then ended the day talking about the latest comments out of the chairman of the Federal Reserve.
This is InvestTalk, independent thinking, shared success.
Let's talk a little bit about a little-known investor from Nebraska, and that is Warren Buffett. Warren Buffett, the world's probably most famous investor, has been building up a significant pile of cash at Berkshire Hathaway, which has some everyday investors wondering if it's a warning sign. With stocks recently hitting all-time highs after Donald Trump's election victory, many are paying attention to Buffett's moves to see if they indicate trouble ahead. Now, some market experts aren't so sure that Berkshire's cash buildup is a red flag. JC Parrott's, a market strategist, pointed out that Buffett's recent cash increases haven't really coincided with market downturns in the past. In fact, stocks have often rallied afterwards, suggesting that Buffett's move might not be a clear indicator of market trouble. Berkshire's cash pile is pretty big. Totals $325 billion by the end of the third quarter, up from $277 at the end of the second quarter. This growth has happened even as Berkshire has sold more stocks than it's bought over the past 5 years, meaning it missed much of the post-COVID market rally. And so you may be asking yourself, and you're not alone, a lot of people are, why all the cash now? Well, there could be several reasons. One possibility, Warren Buffett is 94 years old, right? Meaning that it is likely if he wants to do another big deal, he has one big acquisition he could make. With over $320 billion in cash, you could buy outright Coca-Cola. You could buy Goldman Sachs outright. Maybe he is gearing up for one giant deal. Another potential explanation is that Buffett may be preparing to transition out of active management, right? This is my hypothesis here, is that he's 94. He would eventually, probably in the near term, step down from Berkshire Hathaway. I don't think he's in any rush, but still, he's going to step down. There is going to be a successor. And so that successor is going to want to reshape Berkshire's portfolio for their tenure. And so having that cash position would give that person that opportunity. And so I think it's best not to read too much into this, right? There are logical reasons for his actions beyond concerns about a market downturn. This may feel unsatisfying for investors who are trying to read the tea leaves and who closely follow Buffett's every move, but his strategy isn't really always directly relevant to the average investor. His approach as a 94-year-old billionaire managing a massive conglomerate is understandably different from what works for somebody managing their IRA or their 401k. So while it's tempting to view Buffett's actions as a signal, his cash pile may simply be reflecting Berkshire's need for liquidity, flexibility, or long-term planning rather than an impending market warning. And so for now, the Oracle of Omaha's moves continue to intrigue, even if their meaning remains uncertain. Let's talk a little bit about the market before we head forward for the day. U.S. stocks finished lower, ending near their worst levels. Major indices on track to post weekly declines. The Dow down 47 basis points, S&P 500 down 60, NASDAQ down 64, and Russell 2000's down once again, a big 137 basis points. That's 1.37%. Today's underperformers included pharma, biotech, managed care, A&D, oil services. Outperformers included entertainment, Disney doing well today, semi-caps, airlines, asset managers, those fee-based asset managers, integrated energy, home builders, and tobacco. Treasuries look pretty mixed. The dollar index up 40 basis points. Crude oil up 40 basis points as well. Overall, I think the defensive tone was chalked up somewhat to a more hawkish takeaway from Powell's comments, which we'll talk about later, which came on the heels of the firmer PPI number and jobless claims print this morning. Bond yield backup continues to really be driven by multiple factors, right? Including equity-friendly positive macro surprise momentum, choppy disinflation traction, and more recently, something we talked about a little bit, which is concerns surrounding what a Trump agenda might have on inflation. But still, there's hope for the bulls out there. Bulls still focused on positive seasonality heading into the end of the year, opening up the buyback window, a reset of volatility, and really some FOMO and heightened retail impulse coming off of the market reaching all-time highs, as well as a tailwind potentially next year or really, you expect the latter half of next year for deregulation, and then going into 2026 with a resetting of corporate tax rates. A lot of Fed speak today. Powell said the economy not sending any signals that the central bank really needs to be in a hurry to lower rates, adding that the strength in the economy has been giving the Fed the ability to approach decisions pretty carefully. Fed Governor Kuehler highlighted disinflation trends as well as a rebalanced labor market, but said a pause is probably appropriate. Barkin from Richmond said that uncertainty about inflation is one of the reasons for really being more gradual going forward. On the macro data front, October core PPI largely in line, though final demand services accelerated slightly and final demand goods turned positive after 2 straight negative monthly prints. And on the job side, initial jobless claims came in below consensus, continuing claims in line and down slightly week over week, though still holding near a cycle high.
Hi, I would like to hear your thoughts on ING. Thank you guys for what you do. Thanks.
So ticker ING is ING Groep. It's a global financial firm. I believe it's headquartered in the Netherlands. Yep, it's headquartered in the Netherlands. And they do retail banking, wholesale banking, investment banking, insurance, asset management, all sorts of aspects of the banking business. Now, it's a fairly large bank, about $48 billion market cap. If you see on here, that number is different because that is not in dollars. But what I'm looking at here is in US dollars. So $48 billion market cap. They have a substantial amount of debt, about $191 billion in debt. Actually, that's $206 billion in debt as of the most recent quarter. Their earnings have been pretty flat. They've been buying back shares, and their dividend yield is very, very high. It's sitting at about 6%. So it's projected to be this year. 6.6% is where it's sitting right now. Their dividend per share has increased pretty steadily, though I guess it's actually kind of all over the place, right? It was 62 cents 5 years ago, then 22 cents, 12 cents, 84, 51, 102, projected to be $1.17 this year. And the most striking thing here is actually, if you look at this performance chart, it's been pretty weak relative to the US market over the past 5 years, but that's probably because most of its business is coming out of Europe, which international stocks have not been doing as well as US stocks going into the pandemic, then coming out of the pandemic with the US having really an overall better recovery than the rest of the world. Right? You're seeing 29% of its revenue comes from Netherlands, Poland, 13%, Belgium, 11%, and then the rest from various countries across Europe and also across the globe. And so let's take a look at the growth, right? Interest income up 11% on an annualized basis, expenses up 19%. And that means that their total net interest income has only really grown by about 1.2%. That's pretty slow compared to a lot of those US banks. And because of that, well, they're trading below their book value. Typically, you're seeing US banks, most large banks are trading right about book values, about fair value. So you could say that this is slightly undervalued. But I would say that one thing that is important to me when you're considering financial institutions, and this is one that did have decent earnings. They did beat consensus on the bottom line. But I think one thing here is, aside from their profitability falling a little bit, growth slowing a little bit, the fact that they have a lot of debt on their balance sheet, is that banks primarily, what do? Right? They take in deposits and they lend long, right? They're lending out for various projects. And for me, I just think that the economic recovery still just has not hit Europe in a way that it would lead me towards wanting to invest in an international bank versus a US bank, which is going to be bankrolling based upon, what the campaign said, should be bankrolling US manufacturing, US infrastructure projects. Again, stands to be seen what actually happens. But I think that the growth prospects in the US are better than the growth prospects internationally right now. And therefore, you would likely see a better return from banks and financial institutions that are bankrolling and lending for those US-focused growth projects with US consumers, US retail banking, US asset management. So overall, I think this bank has a lot of debt, and I think this underperformance relative to the US market is showing you, a trend that is not stellar. It's performed in line pretty much with the industry over the past 5 years. But I just think that if you're looking for the theme that's going to drive bank earnings forward, especially in a time when interest rates are coming down, right? We expect that they're lower than they were, about a year ago. I think in the long term, they're probably trending to a little more elevated way, but still, you're going to see that interest income fall down. So I think what you should be looking to see is what thematic drivers are going to drive these financial institutions' earnings. And I just think that some of the U.S. large banks are better than their European counterparts. Thanks for the call. That is ING, ticker ING. Now, you know what? If you feel like you aren't getting enough out of InvestTalk from listening, well, you can also be a viewer. And that's because our audio podcast and radio show is available in video form on our YouTube channel. Just head over to YouTube, go to that little search box and type InvestTalk with 2 T's. And you know what? If you have a question that you really want answered, leave it right in that comment section because we like to get to those. So let's get to one now. This one's on DEO is the ticker, from Iraq Dawn 1964. And it says, what are your thoughts on DEO? Average PDE of almost 29 to 30, and next year earnings about 7. Seems undervalued. I understand the trends on alcohol and drinking, but what do you think at these price levels? Longtime listener, Pakistan Don, thanks for being the best financial podcast I have found. Well, that is very sweet of you to say. Thanks for being one of our best listeners. All right, so ticker DEO, Diageo, if that is how you pronounce it, Diageo. And it is one second, let me pull that up here, and then we'll dive right on it. So Diageo is a multinational beverage company. It distributes alcoholic beverages, including beer, wine, spirits, and ready-to-drink beverages. Their brands include Johnny Walker, Smirnoff, Bailey's, Captain Morgan, Tanqueray, Guinness, Don Julio. Very diverse product base across the entire spectrum of alcohols. And so taking a look at this name, not a lot of info here. It is a $66 billion market cap company. And it looks like its revenue has really flatlined in terms of its growth, right? Over the past 5 years, they've grown at about a 4% clip on an annualized basis, but that's kind of flatlined. And you got to wonder if that is, people paring back on their alcohol spending, right? Going out to dinner, though there's not a lot of evidence within the market that people really pared back that much. And so is it because there is an overarching trend of just people drinking less? And I think that's probably the case, right? They're struggling in Latin America is what I'm seeing here. Their global volumes are down and they've had to drop prices a lot. And so because of that, you're seeing price to earnings fall because, people expect earnings down the road to be less than they may have expected before, right? They're trading at about 16 times forward-looking earnings, price to book value, about 6.6 times. That's well below their 5-year average. And so you may be looking at this and say, okay, it's cheaper than it's been for a while. And sometimes the reason it's cheaper than it's been for a while is because the trends are just not favorable. And it seems to me to be the case for a company like this. People are drinking less. And so the valuation is falling, growth has flatlined, and margins, they've fallen as well, down from 21% to 19%. Not that big, but still substantial, down from 24% pre-pandemic. And so with all of that in mind, I think that this is a situation where the theme is just not in your favor. And because of that, I'm going to have to pass on Diageo, ticker DEO. Let's keep things on moving and head back to the InvestTalk listener bank.
I don't have a lot of time each day to study and dig in like I know is necessary to really understand. Your program has helped a lot, but my question is this basically. If you were in the situation of not working in the field you do, in other words, if you were not a professional investment advisor and were limited on time, how would you pare it down? What are the very minimum basic things that you would want to study to understand before making a stock investment? I know there's a lot of factors, and you do this professionally. Thank you, and you have a great show. Keep it up.
Well, thank you for being a loyal listener. We appreciate that. And that's tough. That's really tough. Right? I think I go back to what Drunken Miller says, which is, and I could be getting the percentages wrong, but the general feeling and consensus and idea is the same. And that is a majority, right? 50, 60% of a stock's return is how is the whole market doing? Which leads you to believe that the most important aspect is understanding what themes are being driven globally. If you don't have as much time to dive into the minutiae of individual companies, you need to understand what factors are shaping the political and economic landscape and how that might affect the market positively and negatively. The next largest slice, probably another 20, 30%, is the sector, right? most of the market is going to appreciate together. But those things that are driving on a more micro scale within the larger picture are what's going to help various sectors, right? How cheap is it to raise capital? Are people looking for bond proxies because bonds are falling and they're looking for income? Is that going to shift it towards the utilities? What is the path of interest rates? How does that affect real estate? All of these things are going to primarily drive sectors together, meaning that 80, 90% of a stock's return isn't even about that individual company. And then when you have all that time on your hands, then you dive into that individual company basis. What companies have really strong moats? What companies have products that are difficult to replicate and you can't really differentiate from on price or quality, right? That's the core of what's going to drive a business. Yes, its balance sheet is incredibly important. Is it levering itself too much? What is going on fundamentally with the company is important. But generally, if you have a well-run company, the ones that are going to do the best are the ones that have products that are not easy to duplicate, that are not easy to replicate, that are not easy to beat, where there aren't really those threats. Those economic moats are what you're really looking for in terms of those individual companies. But you know what? You got to start at the top. You got to understand what's going on with the world and how that is going to drive markets forward.
Yes, I noticed that SMCI has dipped below $18 today. They still have a partnership with an NVIDIA that they initiated in October, I believe, for data storage. Yeah, I wonder if you have any comments about the 10K failure, and the Department of Justice is investigating them, I think, for accounting manipulation. This kind of a value way down here might be a good place to pick it up. I'm just interested to see what your thoughts would be on that, and I will listen for your answer on the program. Thank you very much. Bye-bye.
So SMCI Super Microcomputer, they offer storage systems, server rack technology. And we've gotten a couple calls about this in the past couple months. I think the first call came maybe around 45, around here, 45, 50. And we said no. And then I think we got a last call a couple weeks ago. Maybe it was trading around 25, 26. And once again, I said no. And now that it's trading at $18, I'm still saying no. And the reason why is because, well, that deal with NVIDIA, it looks like they started diverting orders away from SMCI because there's a potential delisting on the horizon. There's a DOJ investigation. There's legal trouble. There's accusations of accounting fraud. And one of those things alone is probably enough reason to stay away from this guy. Anytime there's a fraud allegation, anytime there's a potential criminal investigation, you are looking at outsized risks. And there are areas of the market that you can invest in that can give you the same type of exposure to the AI play that SMCI was. And so redundancy for the sake of clarity, when there's fraud there, potentially, when there's a criminal investigation, stay away. That is Super Microcomputer, SMCI. Now, Donald Trump's recent U.S. election victory, hasn't really ignited the same rally that we saw for copper back in 2016. I'm going to take you back where in 2016, Trump's unexpected win caught, well, pretty much everybody off guard, right? It caught the market off guard, and it led to a rapid realignment of copper's futures and options. This time around, it was a closer race, right? It was a 50-50. We did not know who was going to win, but we could say it was pretty much a coin flip. And because of that, copper was already in risk-off mode. Fund managers held only modest long positions on copper ahead of the election. Interestingly, market focus wasn't just on the US, but also on China, which had its own major event last week, the meeting of China's National People's Congress Standing Committee, where investors had hoped that China would announce robust stimulus measures. Well, what happened? Well, instead, the committee unveiled a $1.4 trillion package aimed at easing local government debt, but it didn't really live up to the metal bulls' expectations of a vast stimulus that could stimulate demand dramatically and broadly. And so Dr. Copper, which is often viewed as a bellwether for economic health, now faces a key question. Could the prospect of U.S. tariffs on Chinese goods prompt China to implement stronger stimulus to support its slowing economy? Following the election directly, copper initially took a hit. It dropped 4.1% on the London Metals Exchange in reaction to what has been a seismic rally in the dollar. However, copper prices, they rebounded pretty quickly, right? Traders started betting that the threats of tariffs could push China to stimulate its economy even more aggressively. Yet on Friday, after China announced a debt restructuring plan for local governments, bullish, or rather when they announced this plan that really dashed the hopes of people expecting a broader and stronger plan, copper closed at $9,443 per metric ton, down 1.3% for the week. And despite some volatility, the overall market reaction was much calmer than in 2016. And so looking ahead, the path of copper remains uncertain. I still think that for industrialization, manufacturing, bringing that back on shore, right? Copper is an important industrial metal. But there are some factors outside of the control that means that the path is less certain moving forward. Trump has promised tariffs of up to 60% on Chinese imports. But these really wouldn't even take effect for several months. And in response to China's rising exports, the Biden administration had already raised import duties on Chinese aluminum, on steel, with Canada and Mexico implementing similar measures. But I mentioned this the other day, right? The first time we had trade tensions, China's economy is a little stronger. Now China's economy is in a more vulnerable position today than it was 8 years ago, making it highly sensitive to these potential new tariffs and could disrupt Chinese demand. As a result, the initial market reaction has really refocused copper traders on what China is going to do next. And so for now, metal bulls hope that a change in U.S. administration might lead to more proactive stimulus measures that could bring back what has been waning Chinese demand. Looks like we got another question lined up and ready to go from our InvestTalk YouTube channel. And this one is about ticker FLR. It says, I put I put a list together of Russell 2000 companies, most of them industrials. I'm very bullish for the outlook of these stocks on my list, and I want to build up a substantial position in this sector. My question today is about Fluor Inc., that is FLUOR, ticker FLR. And what are your thoughts about the Russell 2000? We'll start broad and then get narrow. And the Russell 2000 is a small cap index. It does a good job of delivering the small cap asset class. Why? Well, it is less subjective than the S&P small cap indices in that there is not a committee selecting them, and they do a number of names approach, right? They rank sort the US market by 3,000 names, top 3,000 names. Guess what? Top 1,000, we're going to call that large caps. It's about 90% of the market. Bottom 10%, which happens to be 2,000 names, that's going to be small caps. And so it does a good job because it does it in a replicable way, an understandable way, and you understand the index construction methodology, and it doesn't make active picks, right, like a committee selection does. And so it's a good way to look at the US small cap market. So let's take a look at FLR, that is Fluor. Fluor Corp is a industrial name. They have really a big hand in sustainable energy solutions. They use liquefied natural gas as a big part of them. They produce fuels, chemicals, liquefied natural gas, nuclear power service markets. They're pretty diversified, actually, more than I'd expect. Only about 70% of the revenue comes from North America, 15% from Europe, 17% from places outside of North America and Europe. Looks like their energy products make about 41% of their revenue. Their urban solution, which focuses more on the cities, right? So urban planning makes up about 34% of the revenue. Now, growth is down, right? They've fallen from 5 years ago, where their revenue was about $19 billion down to about $16 billion this year. Though that is some growth coming out of the pandemic. They bottomed out in about 2021, where their revenue reached about $12 billion. And so they have been growing since then. Let's take a look at their margins, right? Return on assets has grown, projected to be about 6% this year, up from 2.9% last year. It was actually negative back in 2019. And their net margin has improved as well, from 5 years ago, 1.2 to about 2.6 this year. Now, it's an $8.6 billion market cap company, so it is a small to mid cap name. 1.1 billion in debt, so not too much debt, and cash flow is improving. Like I said, profitability is improving. They do not pay a dividend. It's pretty strong relative to the overall market. And over the past year, it's climbed from about $35 a share, peaking out, closing in on 60, though it's about $50 per share now. And so with all this in mind, how do the relative valuations look? Well, 3.8 price to book over that 5-year average. Price to cash flow looks like a little skewed there, so we won't really look at that. Price to sales also reaching that near that 5-year peak. I think this is likely to take a little bit of a hit just given how much of it was involved in sustainable energy solutions, and we know the priorities of this upcoming administration. But the exposure to natural gas, the exposure to nuclear power, I think that's pretty bullish for this name. Now, year to date, it's up almost 30%, so it has had quite the run up, but still, looking at its price to book value, it looks relatively cheap, though more expensive than it's been over the past 5 years. But a lot of that's going to be colored by the pandemic. And so I like the theme here. We definitely like industrial names here at InvestTalk and at KPP. And so for FLR, that is Fluor Corporation, you know what? I like it. Thanks for watching. Looks like we got plenty of time before we head into our next break. So why don't we play another question now?
My question is on ticker symbol GLPI. I did a screener, and this comes up on a REIT, and it's in the casino and hotel business. And I was just wondering what you think about it and what's good support level to get in. Already own about a half a position. Thank you.
So ticker GLPI is Gaming and Leisure Properties, Inc. And you know what? It does exactly what you think it does. It invests in acquiring, financing, owning real estate properties that are tied to gaming and also to leisure. Now, it is a fairly large REIT. It's about $13 billion market cap. Let me pull something up over here, so bear with me. Let's take a look at how it's performed. Year to date, it's down about 1.28%, down about 1.73%, down 75 basis points. REITs have not been doing particularly well relative to the overall market as the longer term bonds have ticked a little bit higher. Bond yields have ticked a little bit higher as there's been a bond sell-off. And so taking a look at this company, right, $13 billion market cap, only about $7.6 billion in debt. A lot of REITs are financed by debt. But it also issues a ton of shares, up from 210 million shares to 270 million this year. Now, I know why you're probably into this name. The dividend yield is pretty high right now. About 6.2% is where we're looking at for this year right now. And that's pretty in line with where it has been. Now, the payout ratio is 104%, meaning there is not a lot of room for error here. But, that's how REITs are, right? They tend to have higher payout ratios because of the tax consequences of not paying out all of your dividends. Now, with all of that in mind, earnings have been upgraded. That is something we certainly like. Their yield, like I said, is very attractive. Their balance sheet is surprisingly strong, especially for the business it's in. And so I would say that with regards to other REITs, I think the area of GLPI is a good one. Right? I think that storage REITs are good. I think that gaming, leisure property REITs or gaming and leisure property REITs are good as well because it's a pretty sticky business. Let's look at their geographic breakdown here. Oh, it actually can't get a property on this one, so that's pretty interesting. But all of their revenue is derived from the United States, so we can't really dig into that there. But either way, you see some pretty solid growth here going back 5 years, right? Even in the pandemic, the revenue was pretty solid due to those leases. And so you see that solid growth, even at a time where, well, the interest rate path is uncertain. I think if you're going to look into REITs, investing in REITs, those ones that I mentioned are solid ones to invest in, including GLPI.
Miss Williams from Kentucky. Calling about the banking sector. I'm looking at Zion Bancorp, symbol CION. If you could look at that, see if there's anything you see that as why I shouldn't buy it at this price. I think it looks really good. Thank you. Love the show.
So Zion Bancorp, that is ticker ZION, is exactly what it sounds like. It is a banking company, a financial service company. They offer banking, investment services, financing, mortgage services, escrow services, foreign currency services. They are a small middle market bank, right? Their market cap is about $8.8 billion, about $3.6 billion in debt on their balance sheet. And their dividend yield is hovering at about 3% right now, which is where it's been over the past couple of years. So that's not really a distressing sign there. Now, as have a lot of banks done, I don't know if that sentence grammatically works, but the spirit is still the same. That is, banks have done well over the past year, right? And they've particularly done well year to date, up 35%, up 68% coming out of the time, and a little scare from Silicon Valley Bank. But I think this comes down to something that we actually talked about the other day at KPP is if rates are generally trending higher, if a lot of the facilities that have helped out regional banks are unwinding, and if there is a lot of commercial debt, which tends to be concentrated, right? Commercial real estate debt tends to be concentrated on these banks, these regional banks, and weigh more heavily on their balance sheet. If that's coming due, right, within the next year or so, a couple years, regional banks have outsized risks compared to their larger bank counterparts. And so even though this balance sheet looks pretty solid, right? They're buying back shares, their cash flow is improving, their profitability is solid. Their returns certainly over the past year have been good. It's trading out a valuation well above the 5-year average. And so because of that, I would probably not think that this is the time to buy. Again, I think that within the banking sector right now, given the dynamics, I would tend to tilt more towards those larger banks with more diversified asset bases. And so because of that, because of the relative valuation here, because of the run up it's had, Zion's Bancorp, ZION, that's a pass.
Have your opinion on buying this ETF for a long-term investment? FENY. FENY. Thank you so much.
So ticker FENY is the Fidelity MSCI Energy Index ETF. It was actually the first sector ETF that Fidelity made. What they do is it looks like they have a top-heavy portfolio in the U.S. energy segment with well over half of its portfolio weight in its top 10 holdings. And the top 10 holdings are exactly the names you would expect them to be: ExxonMobil, Chevron, ConocoPhillips, Williams Companies, ONEOK. It's an energy ETF, and therefore it is all energy names. A lot of its revenue comes from the U.S., about 64% of its revenue. It's pretty heavily weighted towards large caps, though it is tracking its sector sector index pretty well. And, I think this comes down to a two-part answer to this question, right? The expense ratio here is about 8 basis points. It's a large fund, about $2 billion. And so the answer to this question comes in multiple respects here. The first is this fund a good way for tracking the energy market? And I think it's probably fine, right? It's very top heavy. It's going to give you a lot of exposure to those large caps. Again, 22% of it in Exxon, 13% of it in Chevron. So maybe you would want a more diversified name that doesn't have 63% of its holdings in the top 10 names. But I think the bigger question is now a good time to get into energy. And I'm of the opinion that I don't think energy is an underweight. I think energy is a market weight right now. I think that a lot of the bluster about increasing energy production and subsidizing energy production, all these things, like we are at a point now where, well, a lot of that's been done, and Exxon themselves are saying that we are kind of at a happy medium here. And so I would put it more in a market weight. But if you want to invest in a company that is, or rather an ETF that is going to not have any caps and be heavily tilted towards a lot of these oil names, I think this is a perfectly fine way to do it. Thanks for the call. Now, before we head off, I want to talk a little bit about Federal Reserve Chair Jerome Powell, who stated on Thursday that with ongoing economic growth and a strong job market, there's no rush to lower interest rates. While inflation remains above Fed's 2% target, Powell believes it's on a sustainable path towards the goal. This suggests borrowing costs could stay elevated for longer, impacting households and businesses. Powell emphasized that while the Fed aims for a neutral policy that neither slows nor speeds up the economy, it's kind of difficult to define what that neutral rate will be in today's environment. There's a lot of factors going on, right? Trump's potential tariffs, tax cuts, immigration policy could all shape economic growth and inflation moving forward. And so the Fed is naturally cautious about speculating without too much concrete evidence of what policy action will be. The chair noted that the economy is currently not showing any distress signals, so there's no need to rush into rate cuts. In his words, if the data let us go a little slower, that seems like a smart thing to do. And so he highlighted the U.S. economy's strong performance, mentioning a low 4.1% unemployment rate, solid growth at 2.5%, and robust consumer spending. Business investment is also up, driven by rising disposable incomes, but still inflation remains a concern. Key inflation measures, like the Personal Consumption Expenditures Index, indicate that core inflation excluding food and energy rose at 2.8% last month, marking a fourth month with little progress in bringing it down. The headline PCE, the Fed's preferred inflation measure, is estimated around 2.3% in October, above its 2% target as well. And so traders are still betting that a quarter point rate cut at the Fed's December meeting is more likely, but Powell cautioned that while disinflation continues, policymakers are carefully watching to ensure it stays on track. An important note, when asked about Trump's campaign promises, Powell avoided speculation, saying that any impact on inflation or growth will only become clear once policies are enacted. He did, however, acknowledge that today's economic conditions differ from when Trump began his first term, with current inflation and productivity both higher. And so for now, the Fed is really in a wait-and-see mode. They're balancing these disinflationary goals with the economy's steady performance. Lastly, Powell stressed that inflation is running much closer to our 2% goal, but hasn't quite reached it yet. And so as investors await December's meeting, the Fed's cautious stance hints that any adjustments in interest rates will be measured and data-driven, with an eye on maintaining economic stability amidst likely policy shifts. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads, which you can get at iTunes, Google Play, and Spotify. And please be sure to leave us a rate and review over there. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. This is a free and confidential service. And also, if you haven't optimized the potential of your 401k, guess what? We can now help you there too. It all starts at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.